Hi, everybody, and thanks so much for joining us today. I'm Karin Price Mueller, the founder of NJMoneyHelp.com, and I'm the personal finance and consumer columnist for NJ.com and the Star Ledger. We're holding this town hall today to talk about the impact of COVID-19 on your personal finances and on businesses. So with me today are the partners of U.S. Financial Services, a financial planning and wealth management firm based in Fairfield, New Jersey. So let me introduce everybody. We've got Steve Gallo, we've got Altair Gobo, we've got Sherry Papetti, Matthew DeFelice, and Joe Sarnecki. So the team's here to help provide insight on how new legislation that's recently been passed and how the legislation is working for you personally, what it's going to mean for your businesses, and taking a look at what it's going to do for their clients and individuals and really everybody all over. It's such huge packages we're looking at. So we're also going to be addressing some questions that I've received directly from readers about some specific coronavirus-related questions. So let's start with the impact of the stimulus on individuals. Steve, with the recent passing of the CARES Act, what can individuals expect?
Well, there's been a lot of media coverage out there about several items here, and the big one is the stimulus payments. Everybody's been looking for that $1,200 check. So the way this works, for individuals whose income is under $75,000, and for married filing joint taxpayers, it's under $150,000, each adult in the household will be receiving a $1,200 stimulus check or direct deposit. And for every dependent in the house, they'd receive $500. However, there is a phase out. So if the individual's income is between $75,000 and $99,000, they will still receive a payment, but that payment will be reduced by $5 for every $100 it exceeds the $75,000 limit. And for married couples, it'll be reduced the same amount for every $100 that their income exceeds $150,000 up to $199,000. At that point, they would receive no stimulus if their income exceeds those numbers. The big question here, everybody's, when am I going to get my payment? A lot of people have received it, and a lot of people still haven't. My best suggestion here is to go to the IRS.gov website and go to the Get My Payment tab. They'll ask you a few questions, and they'll give you some information as to, one, whether you are eligible or not, and two, when you should receive your payment. Most people
that's great.
I'm sorry.
No, I was going to say that's great information, and we do keep hearing from readers that, yes, I got it, or no, I'm still waiting, and how much longer am I going to have to wait? And it's going to be different for everybody.
And it is different for everybody. And by the way, also, you don't have to have income to qualify for the stimulus payment. So even if you're just on Social Security and have no income at all, you'd still be entitled to that payment. Okay. Also, obviously a financial hardship for a lot of people out there. And the concern is, how am I making my mortgage payments? How am I going to make my rent payments? Although this is not an exact law, you'll find that most banks are giving their mortgage holders a 3-month deferral on their payments. Okay, most of them are tacking it on to the end of the loan. So if they have a 3 years, let's say, left on their loan, they defer 3 months payments. They now have 3 years and 3 months left on their loan. But that is not everybody. It's up to the individual banks. You need to call your lender to decide what they're doing rules-wise. In addition, renters, the federal government has announced that they will not do any evictions on people from federal households, federal housing groups. And most landlords are working with their tenants as best they can, especially in large apartment buildings and the like. So I urge everybody here who has any kind of situation like that, as well as credit card debt, car loans, talk to your lenders. Don't just not make the payments. You face it, talk to the people, and you'll find that most of the lenders are cooperating and trying to help out during these times.
That's absolutely right. And now, something else that's going on that's going to help out some people is that they don't have to file their taxes, right? Well,
yes.
Now past April 15th, right? But they got
absolutely. And obviously, we're past April 15th, so most people are aware that they did not have to file their 2019 tax return. Now, if they were getting a refund, obviously they wanted to get that filed and get the refund in the works. But if they owed money, they were not only given an extension of time to file that tax return, but they also were extended the time to make any payments that might have been due in 2019. In addition, the IRS has said you don't have to make your first quarterly payment for 2020 or your second quarterly payment for 2020 until that July 15th date. Most of the states have been following suit. Again, each state is different. New Jersey has extended their filing deadline to July 15th as well as your first quarterly estimated payment. However, your second quarterly estimated payment is still due June 15th to the state of New Jersey, unless they change that.
Now, if you are still waiting to get your tax refund from New Jersey and you haven't gotten it yet, they're having some delays. They've got their people working at home and they're trying to catch up with their backlog. So the normal time that you would expect to get your Jersey money back would be about 12 weeks. And that's now extended in some periods if you had filed with paper. If you did it electronically, it's also going to take longer than usual, but it's coming. It's eventually coming. So, Steve, what about charitable contributions now that we're talking about tax?
There's been two major changes there for 2020. As you know, if you did not itemize your tax returns, you were not entitled to any charitable deduction. However, effective for 2020, the IRS has instituted an above-the-line tax deduction for $300 per person. So again, a little bit of an incentive to hopefully for people to give and help out those in need. Another major change, and this is for more of the heavier donors. In the past, anybody could make a charitable contribution, these itemized deductions. However, it could not exceed 60% of your adjusted gross income. The IRS has waived that for this year, and now you can make charitable contributions up to 100% of your adjusted gross income, therefore eliminating any income tax in 2020 if you were so inclined and had that kind of excess money to donate.
Okay, so that's some great information. Joe, I want to talk to you a little bit about student loans. We all, not me personally, but so many people in America have such heavy student loan debt. What happens now?
No, absolutely. And, you know, another component of the CARES Act that did affect a lot of people, like you mentioned, is the relief that's being provided for individuals with federal student loans. Unfortunately, this relief does not apply to private loans, but for those with federal student loans through September 30th, interest on these federal loans have been adjusted to 0%, as well as the payments have been suspended. Borrowers do have the option, though, to continue to make payments during this time if they're financially able. They can make their regular payments. If they wanted to make a smaller amount, they're able to do that too. The real benefit, though, is with 0% interest rates, any payments that borrowers make during this time are going to be applied directly towards the principal amount, so they're able to chip away at those loans a lot faster.
And that's definitely a huge benefit for people with the loans. What about required minimum distributions? We've got some changes there too.
Yeah, absolutely. Finally, one of the big changes for this year was the waiver of the 2020 required minimum distributions from defined contribution accounts. So these are your 401ks, your IRAs, and it also includes inherited and beneficiary IRAs. So although you have the ability to continue to take your RMD if you want to, for 2020, you're actually not required to do so. One of the things to keep in mind is there's a lot of people, you know, those early birds that took their RMDs, you know, before this act was passed. So they may actually have the ability to roll this back in depending on when they took the distribution. All right. So if you took your RMD after February 1st of this year, you can actually roll it back and you have up until July 15th to do so. If you took it before February 1st, or if it was an inherited or beneficiary IRA, unfortunately, as of now, you know, the rules change every day, it seems, you're not able to roll that back in. One of the things to keep in mind out there is a lot of people are set up and have automatic distributions of their RMDs. So if you're set up for that and you don't need it, you want to make sure you contact your advisor or custodian and let them know that they should suspend it for this year.
Oh, that's a great piece of advice. Now let's turn for a moment to unemployment. Unfortunately, we've just seen a staggering number of people lose their jobs or lose their hours or be furloughed. And you know, just businesses shutting down all over. We don't know when everyone's going to be able to open back up again. So Jerry, can you talk to us a little bit about what the CARES Act did for unemployment benefits?
Sure. I mean, when you look at what's happened over the past month in April, the amount of unemployment claims filed, the state of New Jersey alone has over 1 million employees who have filed for unemployment. As of Friday, approximately 70% of the claims for unemployment have been paid. There's still a significant amount waiting to be processed. Unfortunately, the volume of the system has overwhelmed the ability to process these claims, all the claims, on a timely fashion. New Jersey, for purposes of self-employed or individual independent contractors, they are not eligible to file for a claim for unemployment on New Jersey state unemployment. What the federal pandemic unemployment compensation provision of the CARES Act provided is that gig workers and independent contractors and self-employed individuals are eligible for an additional $600 per week benefit. This $600 per week benefit is over and above whatever the state unemployment benefit is for employees, but for those self-employed individuals, this is a welcome benefit they would not otherwise be able to claim. This $600 per week benefit is going to be paid up through July 31st of this year.
And the benefits are also going to be paid retroactively. So if you lost your job but you didn't file right away, or if you've been waiting several weeks for your benefits to come through, which is what we're hearing from most people, you will be paid that amount retroactively. So at least you won't be out the $600. So how can somebody apply for unemployment?
The way that you would apply is you'd go online to the website, and New Jersey's website is myunemployment.nj.gov. myunemployment.nj.gov, and there is, all the prompts necessary to file your initial claim for unemployment, and realize that the states are also administering the federal pandemic unemployment compensation. So that's how you would also apply for the additional $600 per week.
Okay, that's great. So Matt, let me turn to you. If I have a pension, or if I'm getting Social Security benefits, am I eligible for unemployment?
Yes. In New Jersey, you can collect your full unemployment benefits even if you're collecting Social Security. Social Security does not count at all in the unemployment benefits calculation as earnings. As far as a pension is concerned, unemployment benefits can be reduced if you're collecting a pension, depending upon who contributed to the pension. It could be reduced by up to 100% if your employer contributed the entire amount. It may be reduced by 50% if both you and your employer contributed towards the pension. And if you contributed the entire amount yourself, there would be no reduction in your unemployment benefit. It really just depends. It's a case-by-case scenario depending on the situation.
As with most things, unemployment, that's for sure. So Let me throw at you, Matt, one of my readers' questions. They said, I can't get through to unemployment. We've heard this from so many people, and I haven't gotten any benefits yet. I'm almost out of cash. What should I do for money? I've got a 401k, I've got credit cards, and I have a home equity line, but I really don't want to build up debt. What should I do?
Well, a decision is going to have to be made at some point if they're running out of money, obviously. As far as getting through to unemployment, as Jerry mentioned earlier, the system is just backlogged, so they got to keep trying that. In the meantime, while everything depends on other information on the individual, in general, in order of where I would tap in that instance, the easiest thing, first and foremost, especially if it's already open, is the home equity line. I get that you hate to build debt, but this is kind of a unique situation in an unprecedented time. If the line is already in place, short-term cash needs, that's kind of what it's for. And while interest rates on home equity lines are generally higher than, say, a 30-year fixed rate right now, interest rates are still at historic lows and borrowing costs are cheap. You wouldn't be able to deduct the interest unless the funds are used towards home improvements or renovations, but there would be no adverse consequences tapping this source other than eventually having to pay it off. Additionally, you should realize that HELOCs can be, HELOC meaning home equity line of credits, can be kind of a use it or lose it scenario, meaning that they could be pulled by the financial institution during times of duress if not drawn upon. And there's precedent for this. In 2008, 2009, when we had the financial crisis, banks were actually pulling unused lines of credit from homeowners, meaning if they hadn't drawn on it and it was sitting there for an emergency, they were saying you can no longer use this because property values have dropped. It actually happened to me personally. I had an open line in the house and I got a letter from Chase saying this is no longer available to you. So if we see an extended downturn, it wouldn't surprise me if the banks are hurting that they go down this path again. So that home equity line for sure is the first place I would tap. The 401k, I guess, would be the next resource if you really need to in a pinch. As we spoke about earlier, under the CARES Act provisions, if you, your spouse, or dependents were diagnosed with COVID-19, or you lost your job, or were adversely affected financially by the coronavirus, you're entitled to access your 401k in a couple of ways. First way is a distribution. You could take up to a $100,000 distribution from your 401k without incurring a 10% penalty if you're under 59 and a half. And the mandatory 20% withholding for taxes is waived. Income tax will still be due on that money, but you can spread it over 3 years' time. There is a December 31st, 2020 as of right now deadline for doing this. The pros are you're avoiding the penalty, you're getting income tax deferral. The cons are you're shortchanging your retirement account over the long term by withdrawing now and
You go near the room, close the door.
and taking a distribution during a down market. You can borrow. The other way to do it is you can borrow money from your 401k. You can borrow up to 100% of the vested account balance, up to $100,000 from your 401k. For any repayment on a loan due, they're giving you an extension of a year. So the pros of this are you're not liquidating any portion of your retirement account, and you won't have any income tax due by taking a loan. The cons are you'll need to eventually pay back this loan, or it'll be declared as taxable income. So maybe not ideal, but again, in a pinch, in a unique time, these are both this and the home equity line, I would say, are better choices than going to credit cards, which would be the last resort for me personally. With the exorbitant interest rates on credit card debt, I would prefer clients to look to even borrow funds from family members in a pinch rather than rack up credit card debt, because it can create a hole that it can be difficult to climb out of.
And hopefully this delay in getting unemployment benefits is not going to go on forever. I guess you will always eventually get the retroactive benefits. So even if you had to borrow or use your home equity line, you'd hopefully be able to pay it off pretty quickly once those payments came in. Okay, Al, let's turn to you this time. I want to talk about the stock market. We've seen some really, really ugly times since everything has started happening with the coronavirus. So I want to know what you're telling your clients who are nervous. And, you know, I think even your most confident and risk-taking clients probably have an element of nervousness going on right now with their portfolios. So, you know, my readers have been asking if it's smart to get more aggressive if I need to make up some time because of the losses. And if you're that close, you know, 5-10 years from retirement, what do I do?
Okay, well, more aggressive is a subjective term. More aggressive can mean, you know, I'm all in, or I'm just going to change my portfolio slightly from where I was before to maybe take advantage of some of the downturn in the market. I think the important thing is at this point where, you know, people that invest normally have a plan, and the plan is to achieve some type of goal or objective, whether it's term, intermediate term, or long term. And you should stick with that plan for the most part, okay? And having said that, you know, you probably shouldn't make drastic changes that would go against your normal risk tolerance. Because if I set a plan, you know, 10 years ago and I said I'm willing to take X amount of risk, and now I'm 10 years older, am I willing to take more risk now than I was then, just because the market took a step back? So most of our clients understand that, you know, these kind of situations, although not exactly like this one, but these kind of situations happen periodically where the market takes a step back. And we know historically, you know, we can go back 50, 60, 70 years. Historically, the market comes back. Now, do we have time for it? And depending on where you are in your investment life cycle, you know, that's what needs to be addressed. But let's take a look at, for example, if you look at the last 10 years in the market, okay, if you were invested in the S&P alone, you're probably averaging about 6.2% a year. If you missed the 10 best days of the market, okay, you are down to about 2.3% a year. So you only had to miss less than 0.5% of the trading days in those 10 years, and you would be 1/3 the performance that you would have gotten if you stayed in. So the old adage of, timing the market versus, time in the market, and not trying to, take big chances either in or out. So to the people that are asking the question, should I get more aggressive? What did they do when the market took a downturn? Did they sell? Did they stay the course? Did they maybe apply more, and maybe not all at once, but maybe on a dollar cost averaging type of situation?
Okay, no, thank you very much for that. Now, in general, a time like this is exactly what an emergency fund was made for. Not everybody had one. I guess, let's talk about that a little bit and what people should be thinking about.
Yeah, well, it might be kind of late now. I mean, if you don't have an emergency fund to say I need an emergency fund, but it probably never too late. So, we look at times like this, and it makes us think of, the phrase, we're all in the same boat. And in actuality, we're not, all right? We're all in the same storm, but our boats are different, okay? Some have a bigger boat, smaller boat. Some of us maintained our boat better than others, et cetera, okay? So if your boat needs to be maintained more and you need more dry powder, you need more liquidity, well, that's what you have to address and build up that stock, as far as having liquidity. Because it really all comes down, when you think of it, to cash flow during times like this. If I have enough cash flow to sustain the storm, all right, I'm okay. I don't have to sell anything. I don't have to worry about my 401k, borrowing, this or that. If I have the ability to sustain the storm with cash flow that I have, then I don't have to make major changes. The problem is, and for many people, we don't have the luxury of creating big piles of cash. Perhaps maybe because of our income situation or expense situation. But that's something that should be addressed, normally. How much do I have coming in? How much do I have going out? And what do I need to keep on the side for the what-ifs in life? We're certainly in that period right now.
So that's when we need to take a closer look at our budget.
Well, the budget is an interesting word. Let's call it cash flow, because nobody wants to be on a budget. I try to tell my kids, my wife, everybody, you got to be on a budget, and they throw stuff at me. So, yeah, you have to pay attention to your cash flow. All right. And the cash flow is so simple when you think about it. It's looking at, the economics of the situation, which are how much is coming in and how much is going out. And the going out part is interesting, because the going out part comes in a couple of different flavors. The stuff that has to go out, your fixed expenses, your mortgage, your car payment, et cetera. Okay. And then there's the variable. The going out to dinner, which we haven't done in a while, or buying clothes or buying whatever. So you have fixed and you have variable expenses. The fixed sometimes you can't control. The variable you certainly can control. So once you look at your cash flow and you determine if in fact you do have any discretionary income, and that's income left over after you pay your expenses, then you decide what you're going to do with that income. If you don't have discretionary income available, then we have to work on the plan to see why not. Are you making too little? Are you spending too much? Somewhere in between, what can we do to help?
Okay, so now, here's where we are. We've got whatever income we have whatever emergency funds we have, and our investments are what our investments are. But is this now a good time to reassess?
Now time to reinvest? Well, it depends on your goals. Where are you in the investment life cycle? Are you investing for 20 years from now, or are you investing, for retirement in 2 years, where you might have to change your whole philosophy and go from a growth portfolio to an income portfolio? So depending on where you are, depending on what you're investing for, it certainly should be addressed as far as the type of investments you have. And that asset allocation is important, because, in times like this, one may say they have a certain risk tolerance, but once you put the pedal to the metal and you see where you are, you may not be as risk tolerant as you claim to be. Okay. And this is a test of that. So you always have the economic and the emotional side of the equation. The economic side is easy. You crunch the numbers and you say, this is what it should be like. The emotional side, where you have that gut-wrenching experience, that's the more difficult side to deal with. That's the side that says, could I, should I, would I, as far as dealing with risk, dealing with time horizon, dealing with your specific goals and objectives, etc.
So out there, is there anything else you want people thinking about in terms of their investments right now?
Well, I think, between looking at emergency fund, cash flow, weathering the storm, like I said before, we all have a goal to get from A to B. But it doesn't mean that goal is straight line A to B. If we're experiencing times like this, getting back to my, beautiful boat analogy, all right? If we're experiencing—
That was a fine analogy.
I happen to think so. If our boat can get through the storm, okay, then we might not have to make a lot of changes. But if I have a little dinghy and my boat can't get through the storm, I might have to make some changes. And that's when you sit down and you really look at it objectively and see, what is it that I need to do to weather the storm?
Thanks so much for that. So, Matt, let's turn to you. What kind of opportunities and strategies are you dealing with telling your clients about right now?
Well, we're always talking about, for the right person, principal and income protected products are one of the tools to utilize in their retirement planning. Generations past had a very different framework to complete their retirement planning with. The average person worked for the same company their whole career. They worked until they were 65 years old, and then they retired with a pension. Well, pensions and their Social Security, for the most part, paid for their fixed expenses, and whatever they save for, paid for all the fun stuff. Today, it's a very different world. The average person works for 7 different companies during their career. Their 401k replaced the pension, so the onus became, theirs to save money for themselves. Pensions are all but going away. And we don't have time in this forum to get into all the fiscal problems with our entitlement programs like Social Security and Medicare. Back then, life was just simpler. Planning was easier. Annuities may have gotten a bad reputation in the past as products with high fees, but we find them to be a very useful tool in the right circumstance for retirement income planning for some clients, because they are one of the few, if not only, products that can provide that level of principal protection as well as a guaranteed lifetime income that you can't outlive. They are not appropriate for everyone, certainly, but having a portion of their funds in income protected products can fill like a real void for other people. Of course, like any financial product, the devil is in the details. There are a lot of different annuities out there, and if one is considered, we have to understand what the costs are versus the benefits provided before determining if it makes sense for a particular client.
So is it fair to say then, if an advisor wants their client to invest their entire savings into an annuity, would that be a red flag?
Yes, certainly. It would absolutely be a red flag. Not to use a cliche, but not to put all your eggs in one basket. There are restrictions that annuities offer that you have to be aware of. You can't access all that principal, or you potentially can ruin the benefits that you're paying for. So certainly, we never recommend putting all of your money into an annuity or any particular investment product for that reason. So that would certainly be a red flag to look out for.
Okay, no, that's great. Now, let's talk about Roth IRA conversions. The drop in the stock market combined with, I guess, this strange time that we're living in, it might be an opportunity for some investors.
Yes, absolutely. I mean, there are multiple reasons. There are 4 different reasons, really, why we're having discussion with clients now, and think that it really is something to pay close attention to right now. First and foremost is the decline in the stock market. February 12th, the Dow Jones hit a high of 29,568. And by March 23rd, it had declined all the way to just above 18,000. It was a 38% drop. It remains to be seen if the low has occurred. Of course, we bounced off of that a little bit now. But lower account values in general mean lower taxes owed on any conversions you do. So because IRA values are down now, if you wanted to convert a portion of it, there's less taxes you have to pay on lower values. The second reason is if anyone out there, and there are a lot of people, unfortunately, will have a lower income in 2020 due to COVID-19 because they were laid off, they were furloughed, their business had to shut down. Whatever the case may be, they may find themselves in a lower tax bracket this year than normal. we won't know this really until we see how the year progresses, but we have it on our radar that once, for these particular clients, once you determine where you're going to land this year income-wise, and you know what tax bracket you're really going to kind of land in, it may make sense to convert an amount up to the top of your current tax bracket so that you're not bumping yourself into a higher range, and still getting some of that money into a tax-free account like a Roth may make a lot of sense. The third reason is, look, the market goes up and down all the time. Historically, all bear markets have been followed by a period of recovery. What has varied is the amount of time it takes for the recovery to occur. So when you're dealing with retirement accounts in particular, these funds are generally set aside for longer term goals for most people. So let's say in a year or two, we have a vaccine for the coronavirus and the economy becomes fully operational again and the market resumes its upward march. If we convert now when values are down, then all that recovery is now taking place in a tax-free account. Remember, we've just paid taxes on lower values. So if you have let's say a 25% decline in your account, you've got to make back 33% to get back to where you were. If you have a 50% decline, you've got to make back 100% to get back to where you were. So do we want that 33 or 100% recovery to take place in a tax-deferred account where we will ultimately be taxed on all of that growth, or in a tax-free account where you keep all of it, right? So those are the types of questions we're asking people right now. And the last thought is the current tax code is set to expire in 2026. Many economists are saying that could happen sooner if President Trump doesn't get reelected. So there are a lot of fiscal challenges in this country right now that could force tax rates to move higher in the future. The three biggest expenses in this country currently are the entitlement programs, Social Security and Medicare, and the interest on our national debt. And that national debt number has just increased dramatically with the trillions of dollars the federal government just threw at the economy to support it because of the pandemic. So even though it doesn't really feel like it, we are at historically low rates in this country right now for taxes. And there is precedence for higher rates. So if taxes increase in the future, this may be as good as it gets for quite some time. It may cost more money to do conversions in the future. So we obviously can't be sure what exactly will happen. So why not have some tax deferred money for retirement as well as some tax free? And now may be the perfect time to set that up. It builds flexibility in your planning. And we believe that not only is it important to diversify your investments, but it's equally as important to diversify your retirement savings from a tax perspective.
Oh, that's great advice. Now, in talking about Roth IRAs, they seem to be a favorite when it comes to estate planning because then you're able to give your heirs a tax-free inheritance. What other estate planning issues should we be thinking about right now?
Yeah, I mean, the first one I was going to mention, the segue right into that was the Roth conversions. You're basically giving a gift of paying the taxes today, right? When they inherit it, when the next generation inherits that IRA, taxes still need to be paid on it, income taxes, at whatever bracket they're in. So a Roth conversion, for all intents and purposes, you're getting it out of the way now. If a client doesn't need a particular IRA and they know they're going to pass it to their kids, why not convert it and pay those taxes today? Other strategies with the current environment, I mean, depressed asset values allow donors to transfer wealth to the next generation by gifting them with lower valuations while using up a minimal amount of estate gift and generation skipping transfer tax exemption. Currently, that's set at $11,580,000 per individual. Low interest rates also favor certain estate planning strategies, and the current rates required by the IRS to be used for these strategies are at or near historic lows. An example is of two types of sophisticated strategies for wealthier clients, a grantor retained annuity trust, or a GRAT to use an acronym, or a charitable lead annuity trust, or a CLAT. Without getting into the mechanics of how these strategies work, which is a conversation for another day, minimum interest rates the IRS sets forth for these types of planning vehicles is currently 0.80%, so less than 1% as of May 2020. As a point of reference, in January 2019, this rate was 3.4%. Another way to transfer wealth is personal loans. From family members or intra-family loans. The May 2020 minimum IRS rate was 0.58% for interfamily asset sales or loans of 3 to 9 years. In January 2019, that rate was 2.86%. So both of these strategies, people are really taking some time to look at right now because rates are so low. It's next to nothing to be able to do this. We don't know how long that will continue.
Okay, thank you. So turning to the stock market, Joe, if I've got a portfolio full of losers and I decide, okay, I'm ready to get out of some of them, what kind of tax advantages can I create from this?
Yeah, absolutely. And where appropriate for our clients, and this is a strategy specifically for non-retirement accounts, we're looking to actually tax loss harvest in these portfolios. Like you said, due to this steep sell-off, there are a lot of opportunities with certain holdings to realize that loss that may be beneficial to a client's tax situation. The losses that you realize today can be used to offset current or future gains they may realize. So to try and take advantage of this in this down market is definitely something we're looking at across all non-retirement portfolios.
So I guess now is the time that you're starting to really rebalance portfolios.
Yeah, absolutely. That is another strategy, but this is something we would regularly do throughout the year with all our portfolios is rebalance. To get back to the target allocation that was originally established for the portfolio, we want to make sure that remains intact. So with the recent market downturns, our equity allocations in some portfolios may be lower than it should be. For example, a moderate portfolio that should be allocated 60% in equities, 40% in fixed income, with the downturn may now be 55% in equities and 45% in fixed income. So we would ultimately look to rebalance back to that 60-40 allocation.
Okay, now let's turn and talk about insurance for a moment. Forget about health insurance, but we've seen some companies trying to help their customers to make sure that the insurance policies don't go under during this time.
Yeah, there's a lot going on in the insurance world, and insurance providers are definitely aware to the situation and are trying to help. Like we said, in addition to the questions about the equity markets and investment strategies we've been receiving, a lot of individuals are looking to obtain additional protection for their families through additional life or disability insurance through this time. Obviously, during this crisis with social distancing, the fear of meeting with a medical examiner for blood and urine test is obviously a concern. So understanding this, several insurance companies are now adapting to this new world and finding themselves offering life and disability insurance without the need for a fluid exam. We can't guarantee that you're going to be able to get coverage this way, but our insurance carriers are definitely looking for innovative ways to gather the information needed to issue these policies. So for people looking to obtain or increase their coverage, there's definitely an opportunity during this time without the need for fluid exams.
Okay, great. So now let's talk a little bit more about what's happening to businesses. We're seeing lots of businesses shut their doors permanently, some temporarily. The ones temporarily, many are trying to use the PPP loans. So Jerry, why don't you explain to everybody about PPP and what businesses can do?
Sure. Part of the CARES Act was the Paycheck Protection Program loan, eligible to small businesses as defined as fewer than 500 employees. Businesses can be various type of entity forms, corporations, partnerships, LLCs. It was revised and fine-tuned to make sure that independent contractors and self-employed individuals were also included as available businesses that can apply for the Paycheck Protection Program loan. It's also eligible to 501c3s if you have fewer than 500 employees. Even large types of businesses that have a certain industry code can apply, such as restaurant chains, if employees of a certain chain, their location is fewer than 500. So the PPP loan program, very popular. For the first round, $349 billion of the CARES Act was designated to help small businesses. Paycheck is exactly what it was there for. It was really designed to have businesses maintain their employees, maintain the employment, maintain the health care benefits, and to keep them employed with that company. We've probably all heard of the bad publicity that certain large companies made themselves available to these loan proceeds when they really didn't need it. Those companies had returned the proceeds that they borrowed. Probably one of the most noteworthy companies was the LA Lakers. Applied for a PPP loan, obtained $4.6 million, and then ended up returning it. There was a second round of funding for PPP loans because they ran out of funds within about a 2-week time frame. So these small businesses that are applying for the PPP loans through their banks, an eligible lender through the SBA program, would provide the funding based upon a specific dollar amount. The dollar amount that was eligible for the amount of the PPP loan was 2.5 times the average monthly payroll of the business. So the average monthly payroll over the past 12 months, so when applying for the PPP loan, you could use a fiscal year ending March 31, 2020, or you could use a calendar year 2019. And that payroll would include the wages, the actual cash compensation that you paid an individual. Also included in the definition of payroll, group health insurance premiums, retirement plan contributions paid for by the employer, as well as state employment taxes. That would, for New Jersey taxpayers, be your state unemployment insurance and state disability insurance. Those are eligible costs that would be included in determining the payroll for either the full year of 2019 or fiscal year ending March 31, 2020.
So will people have to pay this money back? Is it a loan? Is it a grant? How does it really work?
Sure. So you get your average payroll 2.5 times. That's the amount that goes on the application for the lender. You'll file that application and hopefully hear good news that you've been approved. Along with those applications, they're going to require supporting documentation such as your payroll records, Form 941s, Form 940, New Jersey WR30s. They need to support, although the lender is not required to audit or substantially verify the amount that's applied for. But the 2.5 times your average monthly payroll loan, that amount, all or a part of it, may be forgiven. And that is one of the attractive features of the PPP loan, is that if you use the loan proceeds to pay eligible expenses, your loan can be forgiven, the full amount. And so determining forgiveness requires you to use the proceeds from the date you receive the loan for the following 8 weeks. And that's a term that's, it's called a covered period. From the date the bank actually gives you the loan into your bank account for the next 8 weeks. During that 8-week period, in order for your loan proceeds to be forgiven, those proceeds have to be used for qualified costs. Those qualified costs include payroll, and I just defined what payroll is. It includes rent, it includes utilities, and it includes interest on, they say, mortgage indebtedness. Now, that can be either a real property or personal property. So basically, interest on business debt is eligible. Now, one of the requirements for forgiveness is that 75% or more of your loan proceeds must be used for payroll.
Now, I'm going to stop you for a second because I've heard complaints from a lot of businesses about that, saying, my payroll really only is made up of, 25 or 30% of my expenses, not a whole 75%.
Yeah, that is a certain concern of small businesses. There has been bipartisan support by a group of senators to reduce the restriction as to forgiveness for purposes of those loan proceeds, so that you would not need to use 75% towards payroll. One of the purposes when you look at the PPP loan was to remove employees off of unemployment. I mean, keep them employed by small businesses would reduce the stress on unemployment. So that was one of the primary purposes, and Mark Rubio, who is one of the chief sponsors of that portion of the bill, came out and said, you know, it's a paycheck protection program, and that's why they placed such a large, you know, threshold of 75% to be used for payroll. But there is support to have that 75% threshold reduced.
Okay, no, that's good to know. Now, here's a question that we've gotten from a few readers. Let's say I'm an LLC and I'm my only employee. Should I be looking at loans? Can I qualify for unemployment? What are my choices?
Sure. Yes, yes, and yes. Okay, so you are certainly eligible as a self-employed individual. As a single member LLC, you are, although a legal entity, an LLC, you're a disregarded entity for tax purposes, and you'll file your business results on Schedule C of your personal 1040. What came out in the third phase of interim rules released by the SBA was that self-employed individuals, the single member LLCs, you are eligible to apply for a PPP loan. What differs in an independent contractor, a self-employed individual, a disregarded entity LLC, is the amount that is used for determining a payroll. And as a self-employed individual, you cannot include health insurance premiums. You cannot include retirement plan contributions for yourself. What is eligible is your net earnings from self-employment. That is your average payroll, and then you take 2.5%. You know, after you get the monthly amount, take 2.5 times that to come up with your loan amount. If a self-employed individual has employees, the full amount of the cash compensation paid to the employee, plus health insurance premiums, plus retirement plan contributions, can be included for the employees. But if you're self-employed, you should consider applying for the PPP loan proceeds. You are unemployed until you get those proceeds, so you also can file for unemployment benefits until which time you get those PPP proceeds. Once you receive those proceeds, you actually pay yourself. And self-employed individuals, they don't have a payroll for themselves. They take a draw, right? Draw off of net profits. So if you had one of the things that the PPP loan program also provided is that compensation in excess of $100,000 per employee is not eligible for purposes of determining your average monthly payroll. So if you're a self-employed individual, up to $100,000 or $8,333 per month is eligible for the loan, times 2.5 times for the monthly payroll. That is something you should pay yourself if you do get the PPP loan proceeds. And another twist that they have you figure your loan amount on 2.5 times monthly payroll, yet the forgiveness period is 8 weeks. So 8 weeks is less than 2 months, and so there is a fraction that you would have to apply towards what you would be able to deem to be forgivable during that 8-week period.
Okay, sounds like we could use some help on the math if we ever get that far.
Yes.
So there are some other loans and credits that might be available to different businesses. Can you tell us a little bit about those?
Sure. The other program that's available is the Economic Injury Disaster Loan Program, the EIDL program. And this program is eligible for businesses where you can borrow up to $2 million in a low interest loan. no more than 3.5%. And the term for which you can repay the loan is 30 years, up to 30 years. So it's available funds for small businesses. If you borrow more than $25,000, collateral will be required. If you borrow more than $200,000, a personal guarantee will also be required. That's different than the PPP loans because the PPP loans requires no collateral, no personal guarantee. Incorporated into the EDL program is a grant, a $10,000 grant, which is something that you're eligible. The SBA, which also administers this program, is to pay or provide that grant within 3 business days of applying. I can tell you I know of no business that has received that $10,000 within 3 days of applying. But that $10,000 grant is a true grant to help your business. It is coordinated with the PPP loan program in that is if you get a PPP loan and you have the loan proceeds forgiven, the loan proceeds that are forgiven are going to be reduced by that $10,000 grant if you also receive the grant. So the EDL loan program is available for small businesses up to $2 million and should be looked at if you really need those funds to maintain and stay in business. Again, 500 or fewer employees is one of the requirements.
Okay, now, so there's also been a lot of talk about payroll tax. What's the status here?
Yeah, well, one of the options, because you can't go for the PPP loan as well as certain credits that are provided and a deferral of tax. Depending upon the type of entity, you also may not be eligible if you're a certain non-for-profit to the PPP loan. So there is a credit, an employee retention credit, right? And this is going to be provided for employees that you retain, and up to $10,000 of their wages are eligible for a 50% credit. So that's $5,000 per employee if you keep these employees employed, in which you can offset the employer obligation for Social Security tax. And it is a refundable credit. So the employee retention credit, if you actually apply for that, you're not eligible for the PPP loan. So that is one, where you have to take a look at what the benefit is on the PPP loan. Usually getting free money is better than a credit, a 50% credit. So most are going for the PPP loan. But if you realize that the PPP loan is not the way to go, this employee retention credit is something to be considered. The other benefit that's also provided to employers is the ability to defer the payment of your employer share of Social Security and Medicare tax and remit the tax that would be due in 2020 to be paid 50% by December 31, 2021 and 50% by December 31, 2022. So that is another available benefit. Again, that deferral is not available if you receive the PPP loan.
Right. Okay, good. Now, any other rules businesses should know about?
Net operating losses have been, really the restrictions and limitations have been released, or I should say, opened up to businesses to be able to apply a net operating loss for 2018, 2019, or 2020 to be able to carry that back 5 years instead of 3 years. Also, there was a limit about how much income could be offset with an NOL to 80%. That's been removed, so you can now offset 100% of prior year's taxable income. And one of the benefits when you take a look at the current maximum corporate tax rate for federal purposes is 21% right now. if you go back to the tax rates prior to the 2017 Tax Act, the highest corporate tax rate was 35%. So this can provide businesses the ability to take a loss right now and offset income that might have been taxed at a higher tax bracket. So it is worth looking at your ability to use net operating losses and carry back, prior 2018, 2019, and 2020 are the periods you can carry back 5 years.
Okay, that's very helpful. You guys, we have covered so much terrific information. Al, is there anything else that you want to add for our watchers today?
Well, I would think for as far as investors are concerned in particular, let's go back for a minute to a comment that was made before about the Dow is down about 38% from its high. And I think if you look back a month or so ago where it seemed like 1,000-point days were going to be the new norm, we're stuck in an era that we get immediate and continuous information. And I think to react on that information immediately is not the thing that we want to do. We don't want to panic, but we want to put things in perspective. I mean, if we were down 38%, we've made a pretty good comeback so far. We're up probably at least 30% or so up from the low. But we've got to go more than 38% that we lost. We probably got to go up at least another 20% to get to the high, maybe more. But the point is, let's not panic. Let's not do anything that's rash. And let's keep in mind that there are a couple of great sayings that we've heard in the past. And two that come to mind are Sir John Templeton, who once said, the four most dangerous words to investors is "this time it's different." Okay. And also I recognize Franklin Roosevelt, who once said, this is a day that will go down in infamy. And if we look at the year 220, we look at, is it really different than everything we've ever experienced? And will it go down in infamy? And I think for sure that hindsight is 2020 is going to have a new meaning to all of us. Okay. We'll always remember 2020 as the year that, the corona virus, COVID-19, and all the effects it had on health, on people's way of living, on the economy. But I don't think this time is different as far as, this is the end of the world. I think if we're looking for the next end, we probably don't have to look that far because the murder hornets are now coming. So if we're looking to get away from the COVID-19 to the next pandemic or epidemic or whatever, there'll always be something. And I think instead of looking at performance every day, we tend to look at our client's plan every day. And are you on track? So if the person, our goal by our planning design was to have X amount of dollars in the next 5, 10, 15, 20 years, when we look at their plan today, they're really not that far off in dollar amounts, as opposed to what we see every day on all the talking heads on TV and wherever we're getting our information from. So look at your plan. Yes, performance is important, but don't make any rash changes.
Okay, very, very wise words to end out today. Look, I want to thank everybody from U.S. Financial Services and Fairfield who came out with such great advice. We've got Joe Cernecki, we've got Jerry Capetti, Al Gobo, Matt DeFelice, and Stephen Gallo. And just leaving you guys all off until we do this the next time, I'm Karin Price Mueller. Stay safe.
And remember, hindsight is 2020. You heard it here first.